am Peter Rose, founder of Longwood Currency Trading. Exit a good trade fast. Why would I say that? Well, look, I'm standing outside. It just stopped pouring. And nature tells us that when it starts to rain, it could be a good day, but if it starts to rain, take shelter. Go inside. And so even though you may have a good trade on, that price action can change instantly. You know that. And so you get out. Why ride through it? Get out. If you stay with a trade that begins to chatter or turn against you, no matter how slightly or whatever, there's always that chance that it won't go just 10 pips against you. It may go 20. It may go 12 pips and turn around and shoot to the moon. And it may end up after the fact that you got caught at the top of a 60 pip, 100 pip pin bar and price got away from you. So when we're talking about trading, particularly in the currency markets, because it's a zero-sum game, probability and statistics play an enormous role in crafting our rules. If you don't understand that, then the rules you're crafting are being crafted for some other market, like a stock market or bond or whatever. And those rules are not applicable in the currency market, and there's a lot of reasons for that. You simply can't, you can't take that chance that you're in a good trade, everything is working out well, and the price is moving in your direction. You haven't got to your profit target yet, or maybe it's way past your, it doesn't make any difference. When you see that it's going to start raining, you come inside. Why wait until you're drenched and then come inside? You may get hit by lightning. And in the currency market, that's exactly the way that it is. If you notice a change in the price, you need to react right away. The same way that when you are looking at your entry, when those entry conditions are met, whatever your rules say those entry conditions are, boom, you gotta go in. Now, you going in may be a limit order that you set, because if price gets to that limit order, then those entry conditions are fulfilled. Doesn't make any difference how you enter, but when you do it quickly. You don't hem and haw about it and all this other crap. You either have rules that are immutable and tell you what to do, or you don't. And so we need to have those same kinds of rules for getting out of a trade, regardless of whether it gets to our profit target or not, or whether it's only 3 pips up off the bar. It doesn't make any difference. When the conditions change, and this is what you have to identify in your rules for entry, you have to have conditions in those rules that say when this happens, or this happens, or this happens, or that happens, and there's only 3 things that's going to happen. You get out, you exit the trade, and you don't exit part of it, you exit all of it. You may build a position, you may stage into a position, but when you exit a position, you need to get out all the way. There is no reason to reverse stage on this stuff. If something looks like it's going to go wrong, if it feels like it's going to go wrong, it's like that proverbial duck. When it walks like a duck and it quacks like a duck, it's probably a duck. So when you have that feeling, when you have that sense or you have some physical condition that indicates that price action is changing, exit the trade. Exit it. Just get out, because you can always get back in. But if you don't get out, the worse it gets, the more emotionally tied to that trade you are. Because look, you got into the trade because it met all your entry conditions. You're committed to it. It's like going to a restaurant. You know, it's a restaurant that you really want to go to, and so you walk in the door, and the line is there, and the hostess comes up, and they say, it'll be a 45-minute hour late. And you wait, and you think, oh, okay. I'll stay, and then 45 minutes goes by and the people haven't finished dining, and it could go to an hour, or it could go, oh, how do you know how long it's going to go? I faced that exact same thing. I went to the, I was in the Italian section down in Boston, going to go to dinner. I had reservations. So I go up to the door. I was 15 minutes early for the reservation. They said, oh, I have to be about 20 minutes or so, 30 minutes. Okay. 30 minutes, I go back. Oh, maybe 20 minutes. Get your table right away. Okay. It took us an hour and a half to get a table that we had a reservation for, and they didn't give a shit. What I should have done is gone to another restaurant. But because this was a really good restaurant, and we really wanted to go there, I wasted 2 hours, and we ended up eating very late, and it screwed up the rest of the evening. Trading is a wonderful thing, and you can make a lot of money, but you know you can lose all of your money. I know, I've done that. And the reason I've done it is because I've hoped that price would turn around. I thought that maybe this was just a minor retracement. I thought the positive motivation for getting in the trade far outweighed any minor negative correction that would be experienced along the way to my path to glory. Those all cost me tens and tens of thousands of dollars in mistakes. And sometimes when you're trading and you're trading large size, you don't have limit stops because you're managing the trade. It's a little bit different sometimes when you're actively taking many trades and you're managing them. You don't want to put a limit stop, because then you're not giving yourself the opportunity to manage that trade, okay? But you have to have the discipline that when it's going wrong for you and it has certain characteristics, I can't tell you what those are in a video. You know, that's something that you got to go shoulder to shoulder with somebody or talk over a video chat or something to try to discuss this stuff. But when you get that there's a difference. You ask anybody that's a surfer. I'm not a surfer, but I've certainly talked to enough of them in my life because my folks retired and moved out to Oceanside, California. So I met a lot of those guys, and they don't say, well, I'm going to get off the board and cut the wave after it's gone 400 feet. They manage that. They manage that by the conditions of the wave, the conditions of their balance, the conditions of everything. They do that in real time. But underlying that is that feeling that, oh man, I'm going into this tube and this just isn't right. I'm gonna cut out because otherwise I'm gonna get swamped. So trading is the same thing. It's just like surfing. You have certain conditions, not rules. Conditions make up a rule. And a rule encompasses just a finite number of conditions that are manageable to take in instantly. And so that's how why I say I only have 3 rules. I want to make my trading simple. And so you have conditions that form the basis of a rule. And you try not to have more than 3 conditions that make up that. When this happens, or this happens, or this happens, or when this happens, and this happens, and this happens, then you execute that. It's very important that when you're constructing your rules, that you know the difference between having or conditions and having and conditions. Because if you have the wrong combination of those, then your rule may not get executed where you thought that it should in your mind. And that's what screws folks up a lot, is how they construct their rules. And they don't understand event response model, and they don't understand all this stuff. I don't know how it's no wonder that 90% of the traders lose 90% of the money, because they don't understand trading. And one of the key hallmarks of understanding trading is knowing when to cut. That's it. You got to know when to cut. As Kenny Rogers said in his famous song, you got to know when to hold 'em and you got to know when to fold 'em. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.